AI has become the most dazzling segment in capital markets, and debates about whether it's repeating the dot-com bubble have never ceased. The question is whether the current AI wave is merely a simple replay of the late 20th century internet bubble, or will rewrite a new legend of technological revolution. Looking back at the 1990s internet bubble, at its core, it was a celebration built on excessive capital. The peace dividend following the end of the Cold War brought fiscal surplus to the United States, while the sharp reduction in U.S. Treasury bond supply triggered an asset shortage. Reforms to the 401k pension system combined with foreign capital inflows from trade liberalization left massive liquidity searching for quality assets, eventually flooding into equity markets. Coinciding with the rise of internet industries, market misjudgment of fiber optic technology's supply capacity created expectations of overestimated demand and underestimated supply. Capital and industry narratives mutually reinforced each other, creating a bubble destined to burst. By early 2000, concentrated equity sell-offs in the primary market coupled with fundamental supply overhang finally punctured this celebration. The more crucial difference lies in fundamental support. During the dot-com bubble, market gains were primarily driven by liquidity and sentiment, with fragile fundamentals. Whereas in this AI wave, Nasdaq component stocks demonstrate robust profitability, not only consistently outperforming the S&P 500, but also showing more sustainable earnings growth, providing a solid safety cushion for stock prices. This earnings plus capital dual driver framework has elevated the AI wave beyond mere concept speculation, establishing a more durable growth trajectory. However, in terms of bubble intensity, today's market remains relatively restrained. Since October 2022, the S&P 500's price performance has outpaced fundamentals by only 27 percentage points, significantly lower than the lead seen at the end and peak of the comparable phases during the dot-com bubble. The style divergence between Nasdaq and the S&P 500 is also only one-third of what was observed back then. This suggests that despite growing concerns about high valuations, from a historical perspective, the valuation pressure on AI-related stocks has not yet reached extreme levels. The more crucial difference lies in fundamental support. During the dot-com bubble, market gains were primarily driven by liquidity and sentiment, with fragile fundamentals, whereas in this AI wave, Nasdaq component stocks demonstrate robust profitability, not only consistently outperforming the S&P 500, but also showing more sustainable earnings growth, providing a solid safety cushion for stock prices. This earnings plus capital dual driver framework has elevated the AI wave beyond mere concept Chao Zuo, establishing a more durable growth trajectory. Looking ahead to the next 2 years, the market path is becoming clearer. The first half of 2026 will serve as a critical inflection point. As the phase of transitioning from technical validation to large-scale implementation concludes, the S&P 500 may experience a moderate correction similar to mid-1998, with an expected pullback to around 6,700 points. For investors, this represents not a risk event, but a golden window to adjust portfolio structure and optimize cost basis for AI positions. After this adjustment period, the market will enter the N-to-N plus phase, characterized by accelerating industry growth rates and value expansion, recreating the bubble-like rally seen from 1999 to early 2000. According to our calculations, under base case assumptions, the S&P 500 could reach a neutral target of 7,500 points by the end of 2026. With full market sentiment release, it might challenge the 9,600-point level by the end of 2027. The Nasdaq index is also expected to continue expanding its excess returns over the S&P 500. Of course, this projection is not without variables. Shifts in Federal Reserve monetary policy, macroeconomic volatility, and AI technology development falling short of expectations could all disrupt market rhythm. Nevertheless, it's undeniable that compared to the internet bubble, this AI wave is supported by stronger industrial foundations and earnings fundamentals. Its development trajectory may echo history's rhythm, but is unlikely to replicate history's ending. For investors, rather than fixating on whether a bubble will burst, it's more prudent to capitalize on the 2026 adjustment window, seeking balance between bubble and value. This is how to capture certain opportunities in this technological revolution.